Tyson Foods, stock ticker TSN, is currently trading around $59. Year to date, they are down 8.5%, but if we zoom out a bit to 1 year, they are down almost 33%. The reason behind this is that the profitability is deteriorating ever since the last couple of earnings reports. And to countermeasure this, Tyson Foods are planning to lay off 1,700 employees, to close 2 plants as well, to try to strengthen the company. And to see whether or not it's a good time to pick up Tyson Foods, if you are interested, I want to jump into our stock screener and then have a look at the intrinsic value behind TSN. So currently, as mentioned, we're trading around $59. The PE non-GAAP fall ratio is 10.6, which is roughly in line with the 5-year average. As you can see here, the 52-week low is 56, so it's dangerously close to 1-year low right now. The dividend yield is 3.2%, and the payout ratio is a pretty healthy 27%. The analyst target price is $67, so there is a bit of room for some capital appreciation. EPS growth above 10%, that's a check, and ROE above 15%, not a check, but very, very close. The dividend data also looks really nice here. If you zoom in a bit, you can see here, it has been increasing their dividend for quite some time. The 10-year dividend growth rate is around 23%, but you want to take a closer look at some of the current years. You can see it's only 5 and 3 and so on percentage. It's been increased. So if we look back here at the early years, it's 33, 50, 50, 44, and so on. So the reason behind the big 10-year growth rate is due to these early years, but ever since the last couple of years, it's been gone down quite a bit. You can see down here that the trend has been decreasing quite a lot. And if you scroll down here to the dividend yield theory valuation, you can see here currently there should be around 24% discount. The 5-year dividend yield theory, we want to be in the blue area. So apparently at the current time, if you believe dividend yield theory, it could be a pretty good idea to buy in if you believe in the long-term outlook of TSN. We also have a lot of other valuation models, so let's jump right into them. First one, Graham's revised valuation model, where we do take the EPS, the PE of a note growth company, the growth rate from TSN, and I have overridden this to only 4. I think it'll grow a little bit slower than what the analysts expect. The average yield of AAA corporate bonds and the current yield of AAA corporate bonds at 4.4, we get an intrinsic value of $74. Jumping into the next one, which is the discounted cash flow model, we do take the free cash flow from the different years, compare their growth, then we have an average growth rate and an applied growth rate. I also limit this to 4% for the next couple of years. Then we do project the future free cash flow using that growth rate. We discount them back using our discount rate to the present value of the future free cash flow. And then we take the cash they have on hand, subtract the debt, and then we arrive at an equity value. With the shares outstanding, we arrive at a fair value of just $19.70. Using the dividend discount model, we do take the dividend payout from the different years. We do apply a growth rate for the future dividends, and using the weighted average cost of capital, we arrive at an intrinsic value of $83. Also, for multiples, we compare Tyson with some of its peers with their EPS and their multiples, and then we arrive at a stock price of $162 at the current time. Next one is the free cash flow valuation, but due to the free cash flow per share being negative this year at minus 12 cents, the intrinsic value obviously can't get calculated. So for this one, I'll just skip right ahead to the last one, which is a Peter Lynch model, where we do have the growth rate, the yield, and the price to earnings ratio combining to an intrinsic value of $40. Before we jump into the summary, thank you so much for watching, and if you've come so far, please subscribe to the channel and like the video. And let's jump into the summary, where we do have all the valuation models. As mentioned, free cash flow model we do want to exclude. That arrives at an average intrinsic value of $76. With the current price being at $59, there's an average discount of 22% at the current time. So even if we apply a pretty good margin of safety of, let's say, 20%, we arrive at roughly acceptable buy price in line with the current price. This is obviously held up quite a bit by the multiples being so high. So if we try to exclude that one, we then arrive at an average intrinsic value of $54. If we try to remove the margin of safety, it has an average discount of being 8% over value right now. So if we say just 10% margin of safety more, we arrive at $48. But obviously, I think it's fair to include this one, even though it's a bit high. So take a little bit care with this one and maybe apply an even higher margin of safety of, let's say, 30%. And then we arrive at an acceptable buy price of $53. Thank you so much for watching, and I'll be seeing you in the next video.